How does a mutual fund work? What comes to our mind when someone mentions mutual fund? Boring. Complicated. Not actually. Let us explain how a mutual fund works. Okay, this is how it works. Investors like us pool in money to form a mutual fund. An asset management company or AMC is appointed to manage the money according to various goals. The AMC has professional people who understand how markets and money work. And then there are trustees of mutual fund who keep monitoring the AMC's activities to ensure that investors' interests are protected. The AMCs take your money and invest in stocks and fixed income investments. Now it's a given that stock markets and bond markets have ups and downs. There is no escape from that fact. To reduce this risk, the asset management company does a very smart thing. For equity investments, they go and invest in not one, but several industries. This ensures that even if one stock doesn't perform well, the better performing stocks balance the dip. For debt investments, they invest in various securities to spread the risk. Debt funds, when teamed with equity investment in diverse industries, make for a great investment combo. It has the growth of equity investment and stability of debt funds. All these factors make mutual fund investments less risky than a common man investing in equity and debt directly, and more beneficial. Okay, what happens after you invest in mutual funds? Once your money is invested in a mutual fund, you are then given units which represent the money invested in the fund. These units are easily redeemable to get back your money, and they are generally mentioned along with the NAV. You must have come across this term. NAV, or net asset value of a mutual fund, represents the value of one unit of your investment after all fund expenses and management fees are paid. So whenever you feel like checking the market value of your investment, you simply need to multiply the given NAV by the number of units you hold. You can invest in a mutual fund in a lump sum manner or in smaller bits through a systematic investment plan called SIP. This makes mutual funds accessible for anyone, salaried, entrepreneurs, businessmen, anyone. You can know more about SIP in our video on advantages of SIP. So, is your investment doing well? Not so well. How do you know? You see, every fund has a fixed benchmark to measure their performance. This benchmark could be part of the Nifty or Sensex. To judge the performance of your fund, you need to check how the fund has performed against the benchmark set for its measurement. The fund manager's task is to analyze the market and cross the set benchmark of the fund. This is exactly why we pay fund managers. So mutual funds can offer many benefits like diversification, liquidity, professional management, low charges, and more. You can go through our video on why should you invest in mutual funds. To invest in mutual funds, call your financial advisor now. Call toll-free 1-800-266-6688 or visit us at www.idfcmf.com.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.